Howdy, y'all. Welcome, everybody, to the Liberty Call. I am Raymond Dahlman, your humble host. It is Monday, November 6th, 2023. Hope everybody's having a fantastical day out there and had a good weekend. It was pretty nice here. Not too chilly, except at night. And the daytimes are pretty nice. I think we have a cold front come through because my sinuses are just killing me right now. So anyways, if it is your first time watching Liberty Call, I'm glad you're here. Thank you very much. If you could do me a favor, if you could give me some thumbs up, likes, shares, subscribes, follows, press the notification bell because you don't want to miss anything smart I say. All right, let's go ahead and get into the numbers for today. Looks like the market clawed back into the green, barely. The Dow Jones was up 0.1%, 34 points, closed at 34,095. S&P 500 up 0.2, closed at 4366. NASDAQ up 0.3%, closed at 13,518. VIX down 0.07, closed at 1490. Canada down 0.41, Brazil up 0.25%, Mexico up 0.73. Over in Europe, Germany was down 0.35, the UK was flat at 0, France down 0.46, the Netherlands down 0.07, Spain down 0.56, Italy down 0.29, Switzerland down 0.03, and Portugal down 0.23. In Russia, both exchanges were green, MOX up 0.83, the RTSI up 0.92. And the overnights, the Nikkei in Japan was up 2.33, Australia up 0.28. Looks like the New Zealand market's open. Let's see here. In China, the Shanghai was up 0.91, the Shenzhen Component up 2.21, China A50 up 0.75%, DJ Shanghai up 1.22, Hang Seng up 1.57, and the Taiwan weighted was up 0.86. Yeah, last week was a bang-up week in the markets. I mean, they were up just hugely. So let's go ahead and get to the weekly weekly economic update and see what it had to say. Make that a little bigger so I can read it. All right, stocks ripped higher last week on a dramatic retreat in bond yields, triggered by easing inflation and a slowing labor market. The Dow Jones Industrial Average was up 5.07. The S&P 500 surged 5.85. NASDAQ was up 6.61 and overseas gained 3.12. All right, stocks jumped higher right from the start of the week, shaking off prior week's sell-off. The combination of on Wednesday of the Fed's decision to keep rates unchanged, which accompanied dovish comments from Fed Chair Powell and a reassuring Treasury announcement on future bond sales, sparked a third straight day of gains. Slight employment gains and weak manufacturing data provided an additional impetus. The rally continued on Thursday following a sharp drop in bond yields that was driven in part by substantially productivity gains and decelerating wage growth. When Friday's monthly employment report was lighter than forecast, yields pulled back further and stocks added to their week's gains. Signs of labor cooling. Last week's employment data showed potential for a cooling labor market after many months of confounding economists' expectations. The first sign was a lower than expected growth in new private sector jobs in October, as reported by the ADP report, which showed a gain of only 113,000 new jobs versus a forecast of 130, while job openings were little changed. Initial and continuing jobless claims also rose, exceeding consensus estimates. On Friday, the government's monthly employment report further confirmed a potentially cooling employment picture, showing in an October slowdown in hiring, 150,000 new jobs versus September's revised gain of 297,000 and an uptick in the unemployment rate to 3.9%. Whew, that's pretty high. Not really. All right, key economic data this week. Thursday, we have jobless claims and consumer sentiment. So it's a pretty light week there. And it's also fairly light on earnings. Tuesday, we have D.R. Horton, Gilead Sciences, Air Products and Chemicals. Wednesday, we have Occidental Petroleum and Walt Disney. And Thursday is Becton and Dickinson and Company. Oh, I'm sorry, Becton Dickinson and Company. That's all one ticker. All right, so that's everything for the weekly update. So pretty positive this week. My ghostwriters had something to be in a good mood about. Anyways, all right, let's get to the stock market recap and see what happened there. U.S. stocks give up some gains on rising Treasury yields. Earnings, Fed speak is eyed. All right, let's see what they had to say here. All right. U.S. stocks experienced some losses as investors considered rising Treasury yields. This week, several Federal Reserve officials are scheduled to share their economic insights, including Chair Jerome Powell. Federal Reserve Governor Lisa Cook mentioned that the anticipation of higher interest rates for a longer period doesn't seem to be the cause of rising long-term rates. This comes after weaker than expected October jobs reports, which has led to expectations that the Fed's rate hiking cycle might be coming to an end, with a possibility of rate cuts next year. Don't get your hopes too far up, guys. Fed funds future suggests there's an 85% chance that the Federal Reserve has finished hiking rates and an 80% chance they might start cutting rates in June. Why? Is inflation going to be like 1.5% at that point? I mean, seriously. And so we have all that cumulative inflation that we haven't even backed out yet. So I'd like to see some deflation back to maybe 2021. Would that be too much to ask? All right. In contrast to the recent yield sell-off, Treasury yields rebounded, but the 10-year Treasury yield rising by 11 basis points to 4.664. Furthermore, regional banks like Zions, Comerica, and PacWest Bancorp faced declines on Monday due to tighter lending conditions in the third quarter, which has led to a decreased demand for loans. The Fed's Q3 Senior Loan Officer Survey raised concerns about the financial health of regional banks following reports of rising loan loss provisions and falling deposits in their quarterly results. While the earnings season is winding down, some key companies, including Walt Disney, Wynn, Occidental Petroleum, and D.R. Horton, will be providing updates this week. We already talked about that. In the electric vehicle industry, Tesla plans to launch a new EV model at its Berlin plant with a targeted price of 25,000 euros, considerably cheaper than the current options available in Germany. Lastly, oil prices rebounded after last week's losses, with Saudi Arabia and Russia confirming they would remain on their ongoing supply reductions until the end of the year. This has raised expectations of tighter oil markets, despite a previous geopolitical risk premium fading as the Israel-Hamas conflict did not escalate into a broader Middle East conflict. Yeah, as long as the Saudis and the Russians, or basically all of OPEC, keeps their production low, we're going to have elevated oil prices. They were going down. They were, I think, at its lowest, West Texas Intermediate was down around 70. Today it's in the 80s or low 80s. So, that's more than a 10% increase. So, certainly I'd like to have it get down to like 50. That'd be great if we get a barrel of oil down to 50. That would have some major shockwaves through the economy as far as savings for everybody else. So. All right. Last up, article from our friends over at First Trust, Mr. Brian Westbury, their chief economist. This one is titled, "Government is Too Darn Big." All right. The article discusses the recent market volatility and changing sentiments in response to Treasury yields and Federal Reserve actions. 2 weeks ago, the 10-year Treasury note yield was around 5%, and the S&P 500 was down over 10%. However, last week, the yield dipped to 4.6%, and the S&P 500 saw a 6% gain, suggesting a shift in market sentiment. Mr. Westbury expresses caution about the perceived soft landing, we'll put that in quotes, achieved by the Federal Reserve, emphasizing that the U.S. economy's underlying issues date back to the Fed's monetary policy changes in 2008. The shift from scarce reserve model to an abundant reserve model with quantitative easing significantly altered how interest rates are determined. The article points out that banks have an abundance of excess reserves, eliminating the need for borrowing and lending market for federal funds. As a result, the Fed essentially determines the federal funds rate, and it has been consistently kept below inflation rates for 83% of the past 15 years. Comparisons are drawn to the 1970s, when the Fed's artificially low rates resulted in inflation and led banks to lend at lower rates than they should have, ultimately causing the downfall of the savings and loan industry. Today's U.S. Commercial banks carry an estimated $650 billion $650 billion loss in their held-to-maturity assets, which aren't marked to market. The Fed pays these banks roughly $300 billion this year to hold reserves, affecting the profits and accumulating losses. The article highlights that the Federal Reserve has made a mess of the banking system, with taxpayers ultimately bearing the burden. The absence of mark-to-market accounting on held-to-maturity assets allows banks to potentially earn their way out of losses, but it restricts their ability to make new loans. The decline in M2 measure of money is also discussed, attributing to the Treasury Department's significant cash holdings at the Fed. The government's expansion and unprecedented involvement in the economy since 2008 indicate that the U.S. is no longer, or that the U.S. no longer operates as a free market capitalist system. I'd agree with that. Basically like a kleptocracy. The government and big business kind of work together to squish us little guys down and keep us under control. So, anyways. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.